plus and minus for 2% or 1% or 0.2% whatsoever, then central bank can reset fixed exchange rate by devaluing or reducing the value of the currency against other currencies. If there is going to be changing, if the market condition is like that, it should be 8, then central bank can announce that it should be 7. And how it can do that, we'll talk about this. It's going to be direct intervention or indirect intervention. We'll talk about at the end of this lecture. There is complete process of how the government do that. So central banks can revalue or increase the value of its currency against other currencies, right? So the free market forces of supply and demand, they are managed by the government, central bank. If supply increases and you fear that the value is going to be decreased, then central bank come and try to adjust accordingly where should be the value, and in the narrow band as well. If there is no narrow band, then they strictly monitor that the price should be at 7. So who is going to devalue or revalue upward? Market forces of demand and supply? No, central bank or the government, right? So the term depreciation and appreciation, we already know that, but just I'm going to go through a little review fast here. It represents the decrease in the value of the currency that is allowed to change in response to market condition. Thus, the term depreciation is more commonly used when describing the decrease in the value of the currency, and appreciation means increase in the value of currencies, so that are not subject to a fixed exchange rate system, right? If increased, which means appreciation, decrease, which means depreciation, right? If it's fixed, then these terminologies are not going to be used. So examples, so the era 1944 to 1971, there is a Bretton Woods agreement, and they said that we are going to fix the value of currencies according to unit of gold. And then there comes Smithsonian agreement, which is 1971 to 1973, and they called for devaluation of the US dollar about 8% against other currencies. Right? Before that, dollar was trading at fixed rate, and due to this, monitoring of fixing the price of dollar, they said that we should be, giving them some relaxation about 8%, so that there's going to be like whatsoever was the monetary policy or government policy at that time. So you are required to comment on advantages and disadvantages. So advantages was it insulate country from risk of currency appreciation. It means currency exchange rate risk was 0 at that time. You are receiving dollars, you already know that you will be receiving that much money. If you are receiving in New Zealand dollar, you know that after 6 months the price is like fixed, so there is no exchange rate risk. I need not to go into buying futures, entering into the currency derivatives. It's like that, right? So it allows firms to engage in direct foreign investment without currency risk. If you want to open a factory, if you want to invest in stock market of other countries or whatsoever, we already know that whatsoever is the profit, we can convert that profit into our home currency, and that is already planned, right? So there is no uncertainty about the currency risk. So disadvantage is that it is on the decree of the government. If the government says that we are going to revalue upward or downward, then only then there is currency risk. So you plan that, because government announcements are sudden, and you already invested in that country and you are expecting a huge return. And what happened during this period, the government revalued upward or revalued downward, then what happened? Maybe the outcome is not according to your expectation. then country and MNC may be more vulnerable to the economic condition in other countries. What if your country is using fix, the other is using some other one, then your profit is going to increase or decrease based on other countries' economic condition. Let's talk about this. So examples, assume that there are only two countries in the world, United States and United Kingdom. So what are their currencies? Dollar and pound. Also assume that there is a fixed exchange rate system. So we are going to talk about this example with others system as well, like floating exchange rate system as well. So pay close attention to this one. Right now, there are two countries, and we assume that there is fixed exchange rate system, so that those two countries trade more frequently with each other. Number one point, which is with respect to the US. If the US experiences much higher inflation rate than the UK, US consumer should buy more goods from UK. Right? Inflation is higher here. So what will be happening here? Imports gonna be increase and exports gonna be decrease, right? And the British consumer should reduce their imports of goods. What happened to the UK? Sorry, here, UK. Their imports gonna be decrease, exports gonna be increase, right? So this reaction would force US production down and unemployment up as well. So when you are importing much from UK, so what happened here to the factories that are making the same product that UK is exporting to US? They're going to be unemployment. Or factories going to be shut down, or production going to be decreased. So that is US perspective. Now UK perspective. It could also cause higher inflation in the UK. And we call this exporting the inflation to other country. How? Because in UK UK exports will be higher and its imports gonna be lower. Why is that? Because inflation in US is higher than UK. What happened? So when excessive demand of British products gonna be high to the supply of British producers, so what happened here? The high inflation in the United States caused high inflation in the UK as well, because they are exporting here, and due to export, what will be happening here? All the suppliers will be going here, price level within the UK start rising. And the government will say that we didn't do anything, and we will be feeling a huge pressure of high inflation. And why is that? Because of US, because they want to consume our goods. So that's what happened in 1960s. The United States experiencing relatively high inflation and was accused of exporting that inflation to some European countries. And the question is how the price level in UK start rising. Because there's going to be a lot of demand of UK products, and UK will be experiencing shortage. Right? So most of the production is consumed by the US, and for locals there are shortages. When there is shortage, price goes up. Right? So that is the economic explanation as well. Now, floating exchange rate system or freely floating exchange rate system. So, in freely floating exchange rate system, the exchange rates are determined by market forces. Which kind of market forces? Supply and demand. So it means a freely floating exchange rate adjusts on a continual basis in response to demand and supply condition for that currency. Looks very nice, right? What are the advantages? Countries more insulated from inflation in other country. How is that? If in that country, let's take the example of UK and US again. In inflation here rises, right? So what happened? So they are consuming more goods. So it pressurizes the UK inflation also upward. Now UK will be importing more US goods. And what happened? Inflation, inflation is going to be transferred. It's going to be like insulated. How? Because UK also inflation rises. It's also inflation rises, but there is exchange rate. So whoever got the highest inflation, its currency go down, right? So we'll be discussing this scenario with respect to UK and US in the next slide as well. Let's talk about its advantage first. The next one is countries more insulated from unemployment of other countries as well. So the disadvantages of fixed exchange rate system, in which fixed exchange rate system is accused of the unemployment and unnecessary inflation from the countries. The remedy is free floating exchange rate system. And also does not require central bank to maintain exchange rates within specified boundaries. It means the role of government is also minimized. So they don't have to establish the central banks and paying huge salaries to those CEOs and workers and all those, because policies are worthless. Why? Because they are letting the market forces to decide what should be the exchange rate system. So it looks very promising. What are the disadvantages? Okay, let's first talk about the example. Here we go. So there are two countries, US and UK. We are continuing with the previous example. And now this is only free floating exchange rate system. So if the United States experiences a high inflation, increase in British demand of goods will place upward pressure on the value of the British pound as well. So what will be happening? Here inflation is highest. Now people start consuming more UK goods. But this will be putting more pressure on pound to increase. Now what will happen? For UK citizens, now when they convert their pound into dollars into pound, it will be more expensive to them. Understand? So the second consequence of the high inflation is that it reduces the demand for US goods and reduces